Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Before we get started, today's video is going to be a shortened, condensed version of what we usually do in our SPX videos. So in this particular video, we're not going to go over all the different aspects of the indicator. We're mainly just going to go over today's trades for this particular session. If you are not familiar with the SPX daily key levels indicator, then look in the description of the video underneath the video on YouTube, and you will see in the description these particular links that go into more details about how the indicator works and the trading strategy. So there's a video overview as well as additional resources with a Google Drive link for descriptions, links to other videos on different topics about the SPX indicator, and then there's also links to longer that are hour to an hour and a half long SPX trading videos that will go into a lot more detail about the indicator and the daily key levels strategy. If you click on this Google Drive link, we'll show you what screen that takes you to. That'll take you to this particular document, which will have links to other specific topics that are covered about certain aspects of utilizing the indicator. Thank you. Hello, in today's video we'll be taking a look at the Friday, January 2nd, 2026 trading session for the CBOE SPX index. We'll be utilizing the Day Trading GPS SPX Daily Key Levels Indicator, specifically the V2.0 version of the indicator, which was released a couple of months ago. Okay, so some of you may already be familiar with how this indicator works, but for those who are new to the channel, who have never seen this indicator, this is going to be a somewhat condensed video that we, rather than the full-length video that we typically present. As mentioned in the preview to the video, I do have links to full session videos which will go over in more detail how this indicator works and go into more detail about certain other aspects of the indicator, as well as there is a link to a Google Drive document that goes over specific topics concerning the indicator that you can also click on in the description of this video. Okay, so the way that this indicator works is it works on TradingView platform only, and it works on two different SPX symbols. The first symbol that it works on is the symbol that you see it on now, which is the CBOE SPX index. So on TradingView, you would go to symbol search and type in SPX, and then you would look for the SPX symbol under the CBOE exchange. This is the official CBOE SPX index that everyone follows, and this is the symbol that you would put the indicator on if you're going to be trading SPX index options. The indicator also works on a second SPX symbol called SPX 500 8-cap, which I'll show you now. Okay, so on TradingView, you would type in SPX 500 under symbol search, and then you would look for the SPX 500 symbol under the 8-cap exchange. So you would use the indicator on this particular symbol if instead of trading SPX index options, you are instead trading SPX through a Forex broker, or you are through your own brokerage account, or if you're taking a trading challenge through a Forex-based challenge company, in which those companies offer that you can take trading challenges for paying a fee, and then you are to make a certain amount of profit, and generally in a certain amount of time, without violating either the daily loss limit that they set or the total loss limit on the account that they set. And if you are able to pass that challenge, then they can offer you a funded account in which you would trade using their risk capital, and then you earn on a profit split, generally somewhere between 80% to 95% going to you of the profits, and the rest going to the trading challenge company. There are about 60 to 80 of those companies. Some of them would be like FTMO, Apex, or the 5%ers. There's approximately 60 to 80 companies in that space that provide trading challenges. So if you're trading either through your own Forex broker account with your own live account, or if you're taking one of those trading challenges, then you would use the indicator on this particular symbol. One reason that you might want to use the indicator on this symbol if you are trading SPX CBOE index options is because with this particular indicator you can get the levels for CBOE SPX 30 minutes before it opens at 9:30 a.m. Eastern. And that is through the second table here when you're on the SPX 500 8 cap symbol. You will see two different tables on your chart. One will be for the SPX 500, and then the levels you see here are for the XPX 500 8 cap CFD on Forex. And then this second table here is the CBOE SPX daily key levels for today's session. And you get these at 9 a.m. 30 minutes before the CBOE SPX open. Reason for that is that the SPX 500 trades in the overnight in the pre-market, whereas the official SPX index on CBOE does not trade in the pre-market and does not trade in the overnight session. It simply trades starting at 9:30 a.m. Eastern New York time through 4 p.m. Eastern New York time when it closes each day. So at 9 a.m., if you want to get the levels 30 minutes before the 9:30 a.m. open, you would simply open up a second chart if you're trading SPX index options, and then you'll be able to get the levels 30 minutes before the 9:30 a.m. open, which allows you some time for planning purposes for the day ahead. All right, now we'll go back to the other chart. Okay, so the way this indicator works while on SPX CBOE is that at 9:30 a.m. Eastern New York time, at the SPX CBOE first tick open, you will see the daily key levels on your chart for CBOE SPX. This table up here is an optional table that you can turn on, and these are going to be all the same levels that you saw on the SPX 500 chart at 9 a.m. on that second additional table. Also, in addition to the normal key levels that the indicator gives, which we'll go over in a second, it also gives 5 other levels that are key levels. One is the pre-market high. One is the pre-market low, the PML. The pre-market high is the PMH. YDH would be the previous trading session's RTH session high. The YDC level is the previous trading session's RTH session close at 4 p.m. And the YDL level is the previous trading session's RTH session low. These are also very important key levels, as they can often be key points for either breakouts or for potential reversals. The main key levels that the indicator gives are going to be, first of all, the SPX Bull Bear KPL level, which for today's session is 68.8286. This is the all-important Bull Bear key pivot level for the session, so it's bullish above this pivot and bearish below this pivot. The other main key levels that the indicator gives are the R1 through R6 levels, which as you can see here on this particular table, and the S1 through S6 levels below the bull bear KPL. The R1 through R6 are the main key levels above the bull bear KPL level. Now with this indicator, you can take bullish or bearish trades not only off of the bull bear key price level, but also off of the other main key levels, specifically on this V2.0 version, the R1 through R6 levels and the S1 through S6 levels. We do have a video on taking trades off of the other main key levels, the S1 through S6 and the R1 through R6 levels. And that video also explains the two different types of trade entries. One is your standard trade entry, and the other is the more conservative trade entry, which takes additional confirmations in order to make it a valid trade entry. So that particular video you can find in the Google Drive link in the description of this video. Once you click on that Google Drive link, you'll see a number of different videos on specific topics, and one of those videos is on taking trades off of the other main key levels, and also explains the two different types of bullish and bearish trade entries, both the standard entry and the more conservative entry, which takes additional confirmations. And that particular video goes into specifics about those two different types of trade entries and shows specific examples. So I would encourage you to watch that video if you have an interest in that particular topic. Now also you'll see some other levels here. You'll see these QL levels, and on the startup of the indicator's default startup is to display the QL above the BBKPL and the QL below the BBKPL. Also on startup, the default display is to display the first midpoint level above the bull bear KPL and the first midpoint level below the bull bear KPL. Now the indicator can also provide the QL levels above and below the other R1 through R6 levels, as well as the S1 through S6 levels. Those you would turn on manually in the user control panel by just going to that particular section and turning on the QL above or below any particular level. But on startup, it's only going to display the QL above and QL below the bull bear KPL, as those are the most important levels typically in the start of 95% or so sessions. And the same thing goes for these midpoint levels here, as those are important in the initial part of the session. As you can see here too, that we also have only the R2 down to the S3. Generally speaking, when you're using this indicator at the beginning of a session, you want to drill down. You would simply go over here to the right axis and you would expand the levels so you're not seeing all 6 levels above and below, as that would end up being more of a squunched up look. So you're drilling down to say the R2 through S2 or the R3 through S3 or some combination thereof. In this particular case, since the price action dictated bearish action as the session progressed, then we opened up down to S3, and then we also added these additional midpoint levels here as they become of great importance once we have a clear direction. So the midpoint levels are not used for trade entries. Only the main key levels, being the bull bear key price level and the R1 through R6 levels and the S1 through S6 levels with the V2.0 indicator, are used for bullish and bearish trade entries, whereas the midpoint levels and the QL levels have different purposes. The QL levels serve only one purpose, and that is for providing a tight stop loss level above and below each main level. So for example, on a bearish entry off of the bull bear key price level, your tight stop loss is going to be the QL above that level. And on a bullish entry from the bull bear key price level, your tight stop loss will be the QL below that level. If you were taking a bearish trade off of R1 as an example, and you wanted to use a tight stop loss, then you would turn on the QL above R1. Or if you were taking a bullish trade off of R1 and you wanted to use the tight stop loss, then you would turn on the QL below R1. And the same thing goes for the other levels for either bullish or bearish trades. The midpoint levels, however, serve several different purposes. One of which is to provide a standard stop loss level depending upon the type of trade you're taking, bullish or bearish, and the particular level that you're taking the bullish or bearish trade from. So for example, on a bearish trade taken from the bull bear key price level, the midpoint level between R1 and the bull bear KPL is going to be your standard stop loss. So if you prefer to use the more liberal standard stop loss on a bearish trade from the bull bear KPL, then you would use that, whereas a tight stop loss you would use the QL above. On a bullish trade off the bull bear key price level, then you would use for a standard stop loss the midpoint level that is between the bull bear KPL and the S1. So that is the mid BBKPL S1. Whereas if you instead preferred to use the tight stop loss level on that bullish trade from the bull bear KPL, then you would simply use the QL below the bull bear KPL. Now I mentioned that the midpoint levels serve several different purposes. So the standard stop loss is one purpose. The other purpose is to gauge continuing momentum on particular moves. So for example, when you have a move such as this here, where you will have a move below the bull bear KPL, and then you have a close below the midpoint, generally speaking, in the majority of sessions, you're going to see that price is seeking the next main level down, in this case S1. And then also when it breaks below the midpoint here, it's generally speaking seeking out the next main level, which in this case is going to be S2. And then here on mid S2, S3, which is a little covered up by these candles here, the midpoint between S2 and S3, generally a close below that will normally result in the majority of sessions in price seeking out the next main level below. In this particular session, we have a confluence of the yesterday's daily close and yesterday's daily low together, and those are also in confluence with this midpoint level here. And we'll go over that aspect later on as far as the context of that for this particular session. And the same thing applies to the midpoint levels above. As you can see here, we did not get above the R1. We don't have the R1 to R2 midpoint level, but it's approximately here where this YDH level is. So if we turn that on and the price had continued to go up and closed above the mid R1, R2 level, then generally it's at least going to be seeking out the YDH level. And then, since that happens to be in confluence here, if that YDH level was not here, then the next main level here would be the R2 level. And these midpoint levels work the same way off of the other R3 through R6 and S3 through S6 levels as well, as far as gauging continuing momentum. The last purpose that they serve is for the different trade types that you can take with this particular indicator. With this particular indicator, there's two different trade types. One is a scalp only trade, and the other is a regular trade. A scalp only trade, you're looking for a one level move in your favor, starting with the level you're taking the trade from and moving in the direction of the trade, whether it's bullish or bearish. A one level move in your favor from the level you're taking the trade from is going to be your exit for a scalp only trade. The other type of trade is a regular trade, which requires a minimum 1.5 level move in your favor. And with a regular trade, you have three different options as far as how to handle at those waypoints once it's hit the 1.5 level move in your favor. So what do I mean by a 1.5 level move in your favor? On a bullish trade from the bull bear KPL, a 1 level move is going to be R1, and a 1.5 level move is going to be the mid R1, R2 level, which again would be about right here where YDH is, and we don't have it turned on in this particular example. And then a 2 level move would be R2. Conversely, on a bearish trade from the bull bear KPL level, the S1 level is a 1 level move for a scalp, and the mid S1, S2 level would be 1.5 level move. So at a 1.5 level move in your favor from a bearish trade off the bull bear KPL, as opposed to a scalp with a 1 level move, which you would just have a 100% exit of your position, at a 1.5 level move in your favor, you have several different options. One is just to go ahead and close out 100%, just like you did with a scalp, except you will have more profit on a 1.5 level move. The second option is to adjust your stop loss to either break even or break even plus a profit buffer. Or the third option, if you're trading multiple options, such as 3 options or more, is that you can scale out by exiting 70 to 90%, closing out 70 to 90% of your multiple options, and then simply adjusting your stop loss if you wish to break even or break even plus a profit buffer on the remaining runner contracts, and you're looking for an additional move in your favor, which on a bearish move would be a move down to the next main level, then the next midpoint level, then these levels YDC, YDL in this particular session, and then the next main level below. And there would be the opposite for a bullish trade. In the case of taking a bullish or bearish trade off of other levels, for example, if you took a bearish trade off of S1, then the S2 is your scalp only exit 1 level move in your favor. And then on a bearish trade from S1, the 1.5 level move for a regular trade would be mid S2, S3, that is a 1 and then a half level below the S1 as an example. And it works the same way on bullish trades off of other levels or bearish trades off of other levels as well. You simply count the number of levels from the level that you're taking the bullish or bearish trade from. Okay, so at this time, we will now get into the trades of the session. There were 3 different trades for this session. We're not going to show them all on one screen. We're going to show them on 3 different screens, one at a time, because there simply wasn't enough space in order to show the option data boxes on each one. Okay, so the first trade that we're showing here is going to be bearish trade number 1, and that is off the 9:30 a.m. opening candle. We're on a 2-minute chart. The chart time frames that are recommended for utilizing the daily key level strategy, which is what we're showing you in this particular video, and that is the strategy that we show in all of our SPX videos, is the daily key level strategy using either 0 DTE options or 1 DTE options. So you can use either 0 DTEs or 1 DTEs. We do have a video on the pros and cons of using 0 DTEs versus 1 DTEs. 1 DTEs do have some advantages over 0 DTEs for this particular day trading strategy, and also 0 DTEs have some advantages over 1 DTEs. So whether you want to use one or the other is simply up to your choice, and you can view that video on that particular topic by again going to the Google Drive link, and you will see a video in the series of different videos there, one of which is the topic on 0 DTE versus 1 DTE. And we also have a couple of different videos in which we actually went through the sessions and showed the price differences on entries of 1 DTE versus 0 DTE, and also how each one panned out in the session as far as either profit or losses, and showing you the differences and how those particular 1 DTE and 0 DTEs react throughout the session. Okay, so we have the 9:30 a.m. opening candle here. It's marked off here. As you can see, we have a significant gap up from the previous daily session close, this YDC level here. And as you can see here, we had the candle open, it wicked above the bull bear KPL level, but it ended up closing below the bull bear KPL. As you can see, we're on a 2-minute chart. Going back to the chart time frames, the 1 minute through 5 minute chart time frames are the recommended chart time frames for this particular strategy. However, as you can see in all of our SPX videos, we use the 2-minute chart time frame as we found that to be the best for this particular strategy within the 1 minute to 5 minute range. However, you may use this indicator with other indicators that you like to use. So in that case, there may be other indicators that you like to use on either a 1 minute or 5 minute chart time frame. And if you'd like to use those indicators to also give you additional confirmations, you can certainly use this indicator on a different time frame than 2 minutes. Just be aware that we have found the 2-minute chart time frame to be the most consistent for this particular strategy. Okay, so the most important aspect of this 9:30 a.m. opening candle is the fact that it is closing below the bull bear key price level. So that is your bearish entry signal if you were taking a trade on the 9:30 a.m. opening candle. With this particular strategy, the 9:30 a.m. opening candle is part of the strategy. However, it's an optional part. It's not mandatory that you take the trade in order to utilize this particular strategy. You can simply wait until price hits a particular level that you prefer. For example, here, you could have waited here and waited for, if you prefer to trade, for example, with this indicator, bullish trades off of S1 for a move either back to the bull bear KPL or for the levels above. You could have simply waited for a bullish entry signal here for S1 for a move back to either the bull bear KPL or the levels above. So just keep in mind that this indicator is for level to level trading. And the 9:30 a.m. candle, those are the rules for the 9:30 a.m. candle. As far as where it closes is the most important aspect of that candle for taking an entry. So in this case, it is going to be a bearish entry on this particular candle. However, it is optional to take the 9:30 a.m. opening candle trade. It is not mandatory with this particular strategy and this indicator. Okay, so we have a 9:30 a.m. opening candle here. As you can see here in the notes, we state that it is still within the acceptable range for a BBKPL level bearish trade on this candle. What we mean by acceptable range, there is a particular video on that. So if you go to the Google Drive link and you look at the list of videos there, you will see that there is a video on 9:30 a.m. candle trades to avoid, how to recognize them, and also discusses the acceptable range for taking a trade. So I would encourage you to look at that particular video. There's also an accompanying PDF document that goes with that video, which goes into more detail along with the video on the acceptable range and what is outside the acceptable range. So this particular candle is within the acceptable range for a bearish trade. And with this particular indicator, on any bullish or bearish trade, there are always going to be 3 different option strikes that you can use. And how you figure out which ones to use is pretty simple. We'll go over that now with this particular trade. The standard play is going to be using an at-the-money option. At the money meaning the closest strike to the level, main level that you're taking the trade from. In this case, it's the bull bear KPL level. And for today's session, the indicator gives the bull bear KPL price as 68.8286. So the closest strike to that is going to be the 68.85 strike, which in this case is going to be a put since we are doing a bearish trade. For those of you not familiar with SPX, SPX trades in 5-point increments, 5-point strike increments. So for example, 68.80, 68.85, 68.90, 68.95, etc. So the midpoint between the 68.80 and the 68.85 is 68.8250. So since this is above 68.8250, then the 68.85 strike is what you use. We're also waiting for the close of the candle to make our purchase of the option, because if this candle had instead continued and closed above, then instead we would be looking at a bullish entry instead of a bearish entry. So you're waiting for the close of the 2-minute candle for your entry. The ask price on the 9:30 a.m. candle close on the 68.85 put option is $14.80. Here's the data box here for that. Now I said that there's 3 different option strikes that you can use with this indicator on any given bullish or bearish trade off of any of the main key levels. So how do you figure out the other 2 strikes is as follows. You take the level that you're taking the trade from, in this case the bull bear KPL. The direction you're taking the trade, in this case down since it's bearish, and we first look for our first alternative strike. We look to the first midpoint. So we look in the first midpoint in the direction of the trade, and that is this level, mid BBKPLS1, 68.7679. So the strike closest to that is going to be 68.75. That would be the 68.75 put option. The ask price on the 9:30 a.m. candle close, this 9:30 a.m. candle closes at 9:32 a.m. So it's 2-minute candle, is $10.20. The final strike, or the third strike you can consider, is 1 level away in the direction that you're trading. So in this case, since the level we're trading from is the bull bear KPL and it's a bearish trade, the S1 level is the furthest strike away that we can consider taking a put option on if we don't want to use one of the other 2 and prefer to use the more out of the money. The S1 is 68.7071, so the closest strike to that is 68.70. 68.70 put on the candle close is $8.40 on the ask. Now, the standard stop loss on this bearish trade on the BBKPL level, as we went over earlier, the standard stop loss on a bearish trade is going to be your midpoint above. The tight stop loss, if you prefer to use a tight stop loss, is going to be the QL above the level you're taking the trade from, since this is a bearish trade. If it was a bullish trade, it would be the opposite. Tight stop loss would be QL below, standard stop loss midpoint below. Okay, as you can see here at the 9:34 a.m. candle, it hits the S1, scalp only, 100% exit for scalp only. And we have the bid prices over here on the candle close of the 9:34 a.m. candle, which closes at 9:36 a.m. So here you'd be exiting your trade here because you have a 1 level move in your favor. 1 level is calculated as the level you're taking the trade from, direction you're taking the trade, 1 level below that, S1. The 68.85 put, the bid on the candle close, $21.50, profit $670 per option. the 68.75 put, 15.60 bid on the candle close, profit $540 per option. The furthest out of the money, 68.70, $13.10 on the bid on the candle close, profit $470. All right, now we'll look at the second trade of the session. The second trade of the session is a bullish entry. A bullish entry on this 9:46 a.m. candle here as it closes back above the bull bear key price level. Keep in mind, as I mentioned earlier, that if you did not want to take this trade here, this 9:30 a.m. optional trade, you could instead have waited and just taken a bullish trade off of the S1 level. So just keep in mind that with this particular indicator, it is for level-to-level trading, and you can take trades off of any of the main levels, the bull bear KPL, the R1 through R6, and S1 through S6. However, in following the 9:30 a.m. candle, this is the next trade here, the 9:46 a.m. candle, as the closeout was here on the scalp. So on this 9:46 a.m. candle, it closes above the bull bear key price level, and it is still within the acceptable range for a bullish trade off the bull bear key price level. Your tight stop loss on this trade is going to be the QL below the BBKPL. Your standard stop loss is going to be the first midpoint below the bull bear KPL on this bullish trade. And how you figure out your strikes on this trade. So, well, we have the same bull bear key price level here. So now we're going to be using the 68.85 call option, since this is a bullish trade. 68.85 call is going to be your standard play. Then you have your two other plays. And just like before, where we were looking below, now we're looking above. So we look to the first midpoint above, 60, excuse me, 68.8894. That is going to be the 68.90 call option. Furthest out of the money, one level above, 68.9501. That's going to be the 68.95 call option. We have the ask prices here on this 9:46 a.m. candle close, $11.30 on the 68.85, $8.60 ask on the close on the 68.90, and $6.30 on the close asking price for the furthest out of the money, 68.95. Again, here were the tight stop loss, standard stop loss. Now here at 10 a.m. we have a hit of the R1 for a scalp only. As you can see, it hits R1 and backs off. And we have the bid prices on the candle close, the 10 a.m. candle. The 68.85, $14.70. That's a profit of $340 per option. The 68.90, $11.50 bid, profit $290 per option. The 68.70, $8.60 on the bid, $230 profit per option. Now we'll look at the next trade for this session. Okay, so the final trade of the session here is bearish entry number 2. We have the 10:10 a.m. candle closing below the bull bear key price level, and the close of this candle is still within the acceptable range for a BBKPL level bearish trade. So we have a bearish entry on this particular candle here. So again, like in the first bearish trade off the BBKPL level, we're using the same stop losses. The standard stop loss is the first midpoint above the level we're taking the trade from, or if you want to use the tight stop loss is the QL above the level we're taking the trade from, the bull bear KPL. Same strikes as the first bearish trade. The standard play at the money, closest strike to the level we're taking the trade from, which in this case is the 68.85 put option. The ask price on the 10:10 a.m. candle close is 14.50. So those are here vertically. 10:10 a.m., 10:10 a.m., 10:10 a.m. Data boxes for these on the 2-minute. The 68.75 closest to this one, and then the 68.70 closest to that one. So the 68.75, $9.70 on the ask, and the 68.70, $7.90. In this particular case, we have quite a fierce move down from the close below the bull bear KPL. So going back to our initial session bias here, and we have at 10:14 a.m. it hits the S1 here on this particular candle. That's your scalp only, one level move for scalp only. And the data boxes are over here, 10:14 a.m. vertically. 68.85 put. Bid on the candle close on this 10:14 a.m. candle, $23.20. Profit $870 per option. The 68.75 is $16.90. Profit $720 per option. The 68.70, $14.20 on the bids. Profit $630 per option. Now, on the very next candle, we have the mid S1, S2 hit. It's again, we have a one level move. This level we're taking the trade from, bearish trade, one level move down, scalp only, 1.5 level move, regular trade, minimum required threshold. So here you have that met at the 10:16 candle, this candle here. Here we have the data boxes for those, and the bid on the candle close for the 10:16 a.m. candle. 68.85 put, 25.80, profit $1,130 per option. 68.75, $19, profit $930 per option. 68.70, 16 on the bid, profit $810 per option. Now we had a little sideways move here on this next candle, and then we had a very forceful move candle down, slicing through S2. So we had the S2 hit on 10:20. These are these candles here. Excuse me, not candles, these data boxes here. Two-level ideal minimum move. What's meant by the ideal minimum move is that on 75–80% of the sessions you'll see in a normal year, we're going to be more of the low to moderate or normal volatility setting. And usually a two-level move in your favor. That means either from the bull bear key price level, or let's say we had S2 and we went back to bull bear key price level, or S1 up to R1, etc. Two-level moves are going to be in your low to moderate normal volatility, going to be the extent of most moves in about 75–80% of the sessions in a normal trading year environment. Extended volatility, or volatility that's expanding, or we get higher volatility sessions, then you'll see more of the 3 level and above, or if we get into extreme volatility situations, then you'll see more of the 5 and 6 level moves, or even above 6 level moves, like we saw in the COVID environment back in the COVID pandemic, or in the Bush crash, 2007–2008 era real estate crash, and then all that other stuff that happened. You get in those types of environments, you can see weeks or even months of very high volatility, in which in that case, you're going to see more of the 3, 4, 5, 6 and above level moves, as opposed to the normal environment where you're going to see more of the 1.5 to 2 level moves. Okay, so here we have the S2 hit. Here are the candle data boxes here. $68.85 put, $32.50 on the bid. On the candle close, profit $1,800 per option. $68.75, $24.90. Profit $1,520 per option. Further side of the money, $68.70. We paid $7.90 for $21.60 on the bid. Profit $1,370 per option. Now here at 1024, as you can see here under S2, we have the midpoint level here, mid S2, S3. And then we have kind of an unusual situation here where we have YDC and YDLs basically stacked on top of each other, and they happen to be occurring right here in this midpoint level area as well. So the tendency when you see something like this, in general, the tendency is when you get to YDC and YDL, not 100% of the time, but the majority of the time, more often than not, the tendency is that at least on the first hit of these YDC, YDL levels, especially after an extended move down, if they're occurring after an extended move down from the bull bear KPL, if there's a lot of room, as opposed to them being closer up here. In this case, they're down here, more 2.5 levels away. Then a lot of times the first hit, you'll see either a stall or a reversal attempt. And reversal attempt is what we got here. And then as you see later, on the second attempt, it slices through it, goes all the way down to S3, and then it's kind of meandering around from that level, not really taking a significant bounce as of yet from that, but on the first hit. So the point is that when you see this occurring at either, if these were either bunched here at this midpoint level or they were bunched near a main level, then you want to be very cognizant of your positions if you're still in this trade, of either exiting the trade or tightening up your stop losses on any remaining contracts, as the tendency is that you're going to see either a stall, consolidation, or an attempt at a reversal like we have here. So, sometimes that's not going to happen. Like I said, nothing is 100%. This is just a tendency, especially on the first hit, especially when there's it's so far away from the bull bear pivot. If these were closer up here, maybe less tendency if they happen to be not as far away, and if they were not bunched together, one stacked on top of the other. So you've got both stacked on top of each other here, and it's happening at this midpoint level here. So it's just something to be aware of when using this indicator. That's why these are very important levels as well, especially these, for example, PMH and PML levels. For there to be any significant move on any given session, not only is on a bullish move, price going to have to go above the bull bear KPL level, but it's going to have to sustain and close above the PMH for any significant move. As you can see here, we had a stall at the PMH level. We wicked up to the R1 level, and then it just could not close. It did have this two candles here, which did, and then it reversed back down, but we're not getting any sustained closes above the PMH level. We're not breaking above the R1 level. And on any given session too, the PML level is also important, because any significant move to the downside, just like the move to the upside, you're going to have to see price not only go closing below the bull bear key price level, but also closing and holding and having successive closes below the PML for there to be any significant downside move. And then also these other YDH, YDC, and YDL levels can also be important points for either stalls or reversals. where if they decisively break through, it can be a indication that the move is going to at least continue to at least the next main level in the direction of where a price is taking, say, above this YDH. The next main level here would be R2, or in this case, next main level below YDC and YDL was this S3 level. Okay, so at 10:24 a.m., the candle hits mid S2, S3, as well as YDC and YDL in this candle here. So this is 2.5 level move. You have 1 level, 1.5 level, 2 level, 2.5 levels, happens to be in confluence with these here. Now, if these levels were even further below, then these would also become additional waypoints for staying in a trade. So if these, say these levels were further below, and this level was just here by itself, then these levels as well would become additional waypoints for decision making as to whether you want to tighten up the stop loss or just exit the trade. In this case, they happen to, like I said, be stacked and also be in confluence with this one here. Okay, so the bid prices on the candle close here: 68.85 put, 41.90 profit, 2,740. 68.75, 33.50 on the bid. On the candle close, profit 2,380 per contract. 68.70 now 29.60 from 790, profit $2,170 per contract. Okay, so that's going to conclude this video. As I mentioned at the beginning of the video, if you have an interest in purchasing this indicator, in return for you taking your time to watch this video today, you can send a request to daytradinggps@gmail.com requesting a discount promo code, which will give you a significant discount off of the regular price for this indicator. All of our indicators are currently sold on a one payment for lifetime access basis. That means you make one payment and then you have access to the indicator for life. What that also means is that if we come out with additional future versions of the indicator which add additional features, or we come out with any updates to the indicator, then you will also receive those since you have lifetime access at no additional charge. Okay, so also if you like this video, please go ahead and hit the like button as it helps us with the YouTube algorithm, so we'd appreciate that. And if you'd like to be notified of when other videos are posted to this channel, simply hit the subscribe button and you'll receive notifications of new posted videos. So again, thank you for taking the time for watching this video today, and we wish you much prosperity in 2026 in all your trading endeavors.